There's a lot to cover here. First and foremost, let's get it, the big 800-pound gorillas off our backs, that being the Fed and Apple. So I took some notes on the Fed decision. I wanted to show you guys, this is going a little off script here. These were my Fed notes from the last meeting, and these were my notes from this meeting. Very, very, very few things to say. Important, don't get me wrong. Sometimes, a postcard can be just as important as a 500-pound or a 500-page novel. But let's get to it. So the Fed talked. I was looking for a few key things for the Fed to mention today. The most important, which they sort of ignored, which was Yellen in her last speech played up a lot of her fears of foreign risk. Mostly China, Europe, particularly the Brexit and so on and so forth without naming it. But that was glaringly missing for the most part. I think they may have had a little mention it. I kind of had to go back and read. So that wasn't in there. They did, however, mention that they're falling short on inflation. That was important. That's very important. That was the second thing I said we need to look at. They didn't mention their crazy tongue twister with their the balanced, what was the exact term? I forget what they had said. Crud, I can't find. They didn't talk much about the neutral Fed funds rate, and they didn't talk about their gradual pace of gradualism. That was possibly, I think the first time I heard that, I started laughing. It was a good thing I wasn't drinking anything, or it would have been coming out of my nose. That's how ridiculous some of the stuff that they've been putting in these releases has been. But they mentioned that they have been seeing some improvements with the labor market, but they acknowledged growth is slowing. That is key. So out of the three things that we wanted to hear, they didn't talk too much about like I said, about the foreign issues. They did, however, talk about that they're missing their inflation targets. That's very, very key. And they also talked that growth is slowing. So what does that mean? It means no rate hikes. Dovish, the dovish Fed. There are a few causes for concern. The reason the market rallied today, based on this, was because every pullback has been on low volume. I'll tell you, if you told me in a week, Apple, Google, Netflix were all getting creamed, I mean crushed, and you would tell me today that the SPY with Apple down, what did it finish down? It was down like $8 at one point. It finished down almost $7. That the market would actually be up, I would have been like, get the F out of here. But no, it's real. It actually happened. They talked about the slow pace of business investment. They also talked that they did see improvement in housing. So those are interesting bedfellows. Slow pace of business investment means that the growth expectations are lowered. Meaning, not only are things weak, go back to the previous statement I said, but they are getting worse. They also talked about the housing market improving. That's sort of like excuse me, but for the housing market and for the auto market to stay healthy, we need lower rates, lower for longer. So that's really what I think the market took out of today's statement. However, and this is the important, most traders, particularly when you're into the QE time, I'm going to create a new hashtag right now. You guys are going to be the pioneers for this, and it's going to be called the junkie market. Hashtag junkie market. What does that mean? Junkies, and they've done studies on this, like instant gratification. If you offered them a lollipop today, or you told them if they waited they could have 10 lollipops tomorrow, they will take the lollipop today every time. Here is the cause for concern. The market was happy that July is pretty much off the table. Today, obviously, nothing is expected. June and July, I think, are very, very unlikely with the Brexit coming up. The little cause for concern, and here's the little hiccup. September it had gotten up to 59% today. It closed at 54%. But the market is factoring in a possible rate hike in September. Remember, the Fed said that there is a possibility of 2. They lowered their expectations to 4, from 4 to 2. The market took it as 1, but now it's sort of back up to 2. December is, I would say at this point, barring some type of a debacle, and believe me, debacles happen, is 70%. That's a done deal. I think that they are kind of, it's sort of like the Christmas party. What did we have last year for the Christmas party? I guess we'll just do it there again because it's easier than planning something new. Seems like that's going to be happening. It's also, yes, post the election after November. There's nothing happening, in my opinion. I don't think September will happen unless oil really gets jiggy. Then there might be some tough talk, but it seems like the Fed is out of the way. The next, the big concern, the big fear is going to be the Brexit, and I think that's later on in June or July. I have to take a look. If anyone knows that, if you could type that on the screen, that would be good. So that's that. I mean, the Fed really, I called it, this was a punt. I don't even know why they gave the statement. It was just so boring. I mean, this was just basically, they should have just said, read our last statement or refer back to the Yellen notes, your Yellen notes from the last meeting. It was basically more of the same, and I know they're I don't know if they want to mention it, but they have to be terrified about what's going on overseas. Brazil is almost in the throes of almost a coup. They're trying to boot Ms. Rousseff out of office. I think was a terrible choice for them to begin with. I mean, she was basically like a gorilla who they made the president. It's crazy. So that's that. You've got a lot of instability in these countries. The economies overseas, we know, are not doing better. I would say that any pickup in Europe, which we've seen, is because of the low energy. If that starts coming back up again, they're going to be right back in the shitter. So that's the story. Apple. Oh boy. So I was really hoping for a shake and bake scenario in Apple. We didn't really get it. The problem, it was coming down. I had talked about that wash down job that we saw from Nikkei, and I said when things like that happen, it's a little eyebrow raising. I'm going to talk about Exxon in a moment. They did something today that I don't like. That is the... Anyway, we didn't really get the shake and bake. We did get down days in Apple. We got the gap fill I was looking for at 96.69. It went a little bit lower and rallied, and now we have a range. My big problem, I think the biggest problem for Apple, and this is what I mentioned in a tweet after the market yesterday, the biggest issues that Apple has now is they're going to have a lot of downgrades. They got a few today, but they weren't, bearish enough. You have a lot of people who are long. You have multiple distributions of stock above, basically from 103 on down. And those people are under wrong and long and wrong. That's not really where you want to be. And they also don't have any catalysts until June, until the Worldwide Developer Conference. So there's really not that much in terms of reason to buy Apple. Apple likes to fill gaps. I'm sure this gap will fill. I don't know that it doesn't need to see lower first. We know 92 was a key level. So I think you can use, if you're long, use today's low as a stop. I think below there gets not good. All right, so that's Apple. My theory for Apple, the problem is that Wall Street doesn't like, I guess, gadget companies alone. They need more revenue streams, and I think they've blown a few really prominent opportunities. They've never really gotten into social. They tried that Ping. It was a disaster. They've not doing anything in terms of subscription service. I know they're trying that Apple Music. It's terrible service. They should still but just buy Pandora and or Spotify. And they have done nothing in terms of movies to compete with Amazon and Netflix. They should have bought Netflix when Netflix was in the dumps, when they were still talking about the Quickster days. They could have picked it up for nothing. They absolutely should not buy GoPro. Who was talking about that is absolutely crazy. If they buy GoPro, they're going to have to write it off in a couple of years, like Cisco did with that piece of junk. They have a flip camera. They should not buy GoPro. But they don't have a video service either. Yes, okay, all right, I was hoping so. They need to do more. They need to do more in terms of other streams of revenue. Apple buying Twitter. They could. I mean, I'll tell you, anyone who should buy Twitter, any of these failing news companies like the New York Times, any one of those conglomerates should actually buy Twitter. I think that would keep the lights on indefinitely. I would prefer buying Twitter, believe it or not, over Yahoo. Someone mentioned about Yahoo. Yahoo is just a burning platform. I mean, why do you need Yahoo? Why would you give Yahoo advertising dollars if you can give it to Google or you can give it to Facebook? Which leads us into the disaster of yesterday. I was going to say disaster du jour, although my French isn't good enough to know about that. But and the hero move today of Facebook. So I got asked by one of my followers the other day. I don't know if he wants to remain nameless or not. He was asking me, what is your pick of the year? I guess because I had Facebook last year and it worked out really well. That was my favorite of the FANGs. And in the beginning of the year, I had talked about, you're welcome, I had talked about that Facebook is the only one of the FANGs I think will still do well this year. So I guess he was saying, okay, now that Facebook is kind of played out, which is the stock, meaning it went up, which is the one, I'm just moving this to get this glare. Sorry, there's glare behind me. Which of them would you stick with? And I gave him the Frank Sinatra quote. I said, stick with the girl you came in with, but get it lower. So we got a little bit of a move down in Facebook today. The last few days, there was a news report, a wash down report on Facebook too, which had me a little scratching my head, but it was met with buyers. That was on the 13th. So I said to use that range. So today we had a little bit of a look below and fail on the 100 MA. I guess it was enough of a shakeout. I didn't really consider this, believe it or not, really a full true shake and bake, because it really never got panicky. I guess a little bit today at the very lows. It was a little bit, and I said if you're going to do it half size. For an earnings specific trade. I also talked about selling sub 100 puts. All of those trades all worked out really well. I've loved Facebook. It's funny, I hated Facebook at the IPO at 38. And I turned at 20, it went to 19, and I've never really, other than tactical trading points, ever have looked back on Facebook, because I feel that it's a sea change. They are picking up on not only, they're going to wait until they get into search too. That's going to be something, and that's coming. I can almost guarantee you. It's a generational shift of where advertising dollars are going to. Not going to print advertising, not even now going as much to Google. They are actually, I think the reason Google saw declines is because people are putting their money into social. I think when you look back on deals, all-time great deals, the Facebook purchase of Instagram for $1 billion, which everyone said was crazy overpriced, is going to be maybe the Harvard business case of steals. This was just absolutely incredible. That's valued, I think the last time I looked was a year or two ago, and it was like $35 billion. It wouldn't even surprise me if it would wind up being worth more. I'll tell you this. I do use social media quite a bit. I use Twitter, I use Facebook, and I use Instagram. I tried that Snapchat thing. I don't know. It's a little complicated to me, and that dog ear with the rollout tongue. It's a little stupid. I mean, whatever. I guess I'm a little too old for that. But I will tell you this: people have created, particularly models, have created entire careers based on Instagram. A lot of the agencies, believe it or not, won't hire girls unless they have 10,000 or more followers. So you basically have hot chicks on there all day long posting sexy photos. That being said, it is a very popular form of communication. I think they will do wonders monetizing that, as they are doing with Facebook. There is now a shift going on from, I guess, even traditional Google to social and mobile, which is Facebook. They own that market, and they are killing it. So you now have a few good things going for you with Facebook. One, we don't know yet. I can't say this definitively yet because Amazon has not reported yet, but they are the only momentum stock now that has reported and really gone higher. Earnings behind you, stock higher at all-time highs, no overhead supply. It's going higher, I think. The 1.618 Fibonacci extension from the 117.59 high to the 96.82 pullback would take you to 130.43. Yep, that could be a new PT for the Facebook. I have no reason other than the market collapsing to see that not happening. The progression line, this is so annoying. Anyone who's watched me for a while knows that the progression line has a mind of its own, and it's, for some reason today in the 118 mode, it's really in the 116 mode. So if you were to use the progression line in today's mode, that's around 120s. So I think around that area could be a little bit of resistance, although I think we're going to go through the progression line. It is not unheard of to see us move through the progression line. It just becomes a little unsustainable. So I think we're going through there just because it's so close to the old all-time highs. I like the Facebook. I think that they're going to have a hard time. I think that's going to be the safety play for momentum traders. That's really what I think, because Apple blew up, Netflix blew up, Google blew up, although I do expect those two to get maybe a little bit of bounce off this, because there's options pinning and you have Facebook higher, and after 5 or 6 days of straight selling, should be a little bit of a bounce in those names. But Facebook to me is, like I said, stick with the girl you came in with. Facebook is my pick. They're doing some kind of crazy split I saw, where similar to what Google did. I really hope there's no Facebook L, Google L, Facebook L. Oh God, I'm sure it'll happen at some point. Yeah, I saw Amazon's up a little bit. Amazon, someone had posted, a guy I follow who follows me, and I don't know, we seem to have a little bromance going with starring each other's posts. He was talking about how Amazon is not really a tech stock. It's really like the number one retail. That is 100% true. I'll tell you, Amazon is very dangerous because you can order whatever you want, whenever you want. You got to, it's really a fantastic tool. I shop on there quite a bit. I use it on the iPhone all the time. If I'm out and I think of something, I just buy it. Incidentally, I was looking for a pair of boots. I gave this example a while ago. I was in a store in my neighborhood. It was $10 more, or 10 or 20. It was significantly more. I think it was $20 more in the store than it was on Amazon. And before I had even left it, I tried it on in the store, figured out my size, and before I left the store, it was already ordered from Amazon. So that is it's really happening. That showrooming is really, it's a thing. I like what they're doing with bundling their video in, Amazon Prime or whatever. You get access to their shows. I know they're starting to make some proprietary showings to take on Netflix. So Amazon is one of those. It's going to do well. This is historically not the best time of year for them. The stock usually tends to pull back and then winds up being a bit of a buy into the end of the summer, sort of like Apple becomes. So I'm not necessarily. I have to see how this Amazon trades. If it winds up trading much higher into the quarter, it might be an opportunity to book some profits. I mean, the pattern in Amazon to me looks like it had the breakdown, the check back to the 635. Sorry, where I said I thought it would top. It wound up topping, pulling back. It's in a channel here. You have to see how it handles the 619s here. Where is Amazon? It's just below 619. Anything below 619.45 to me still remains vulnerable. If you can clear those double tops here from the 3-day range of the 626.98, it probably will go higher. Anyway, I snuck that Amazon in there. So the question now for the market, and I know this is what's been confounding all the TV pundits. Yeah, I like PayPal too. Someone was asking about PayPal. They get a thumbs up from me. I have to look at their quarter and how the price is reacting. It's really not part of my game plan for the video here, but I like it as a BTD stock. Anyway, the problem for the TV pundits is they keep talking about slowing growth, junky earnings, and an expensive PE multiple for the stock market. What they forget to mention every time, and I don't know if these guys went to business school or if they were selling cars before they went into finance, but I learned discounted cash flow valuations. And first thing we were taught, I took a lot of classes on money and banking. I actually, believe it or not, took classes on the Fed. Quite complicated classes, a lot more sophisticated than the analysis you get on TV here. I don't remember everything I learned in those classes, but I did remember this. The interest rates are very important to the stock market. And it amazes me every time I turn on the TV and they talk about bonds rallying and this being bad for stocks. I'm like, what the hell are these people talking about? Lower rates are good for stock prices. Why? Because in discounted cash flow valuation, you use a discount factor. The correct one to use is known as the weighted average cost of capital, also known as WACC. That includes for companies that have debt, and we all know that a lot of these companies have been doing all kinds of jiggering and refinancing, being able to borrow at rates that are cheaper than the government. This is an absolute bonanza here for companies like Apple or whatever who are buying back stock. They can also do riskier projects. The hurdle rate, which is known as the discount rate when you're analyzing for a project, is known as the hurdle rate. You can take on projects here that you would not be profitable in the past because rates are so low. Anyway, let's do simple division. I don't want to get too complicated for you guys. Let's do DCF for dummies. You have a top number. You have a bottom number. You have an end product. That's your stock price. The weighted average cost of capital, your discount factor, goes into the denominator. If you have a lower number on the bottom dividing the top number, you have a higher end product. If you have a higher number on the bottom dividing the top number, you have a lower end product. That is PE multiple expansion, and the market does deserve a premium multiple when you have interest rates that are like barely 2%. That is a big deal. I know back in the 90s, when the dot-com boom was going in 1929, when the boom then was going, interest rates topped at 6%. That's what causes all the problems. I think it was the same in 2007. The Fed has apparently gotten some religion under the tutelage of one Benjamin Bernanke. He talked about lowering interest rates for a lot longer, and Janet Yellen has been, I guess here, the falcon has heard the falconer here, and she is keeping rates low. She's talked about normalizing at 3.5%. That's a big deal. They have learned from their mistakes. They're not going to take interest rates up to the point and crash the tape again. They also are talking about normalizing like 2 or 3 years out at those levels, and we know that inflation is lower than expected, so they probably won't normalize. The new normal, which is 3.5%, not 5 or 6%, could be years out. I mean, it's just incredible what's going on. So this is why the market is being higher. This is why you have, I know that some of these have been coming in a lot lately, like Coca-Cola got a little unsustainable at 26. Coca-Cola was traded for selling sugar water, as Steve Jobs called it, when he hired John Scully from Pepsi. He said to him, do you want to sell sugar water your whole life, or do you want to come with me and change the world? Google, who is changing the world, is trading at a cheaper PE multiple than the guys making the sugar water because they're selling a 3% dividend. That's how, in the end, listen, this all ends badly. We all know that. But it could go for years, believe it or not. People are chasing these stocks, paying up for their earnings, PE multiple expansion, because they have nowhere else to get their money. Try going to your bank and getting a rate. Try to get a CD, a certificate of deposit. They'll laugh at you. You get no return. Bonds are yielding nothing. This is the deal. And this is what the Fed wants. They want higher asset prices. They want to reflate. There is such a lack of fiscal policy coming out of the administration, out of Congress, that the Fed is sort of the only engine. It's the only game in town. So everyone, it amazes me. Everyone, holds the Bible high, and they talk about, the Fed having some discipline. They want to rein them in. There is no other game in town. The Fed is the only game in town. So until that changes, I don't really see why they would be changing policy, particularly with low inflation. That being said, oil and commodities are starting to tick up. I think they've sniffed out that the Fed is, I don't want to say a toothless tiger, but they certainly aren't. They certainly aren't, biting your arm off. So people are taking some forays into some of these beaten down areas. I was looking at some of these financial stocks. They're starting to act a little bit better here too. I'll tell you, I think that the aha moment came with Goldman Sachs, with that Dick Beauvais guy calling them out, that none of these banks have really changed their business models. They do loans, but they're not allowed to do the risky stuff, the backroom, the 3-card Monte and the backroom dice games like they used to do pre Dodd-Frank. So they aren't able to make money like they used to. It is basically a utility at this point that pays dividends, and if people refinance loans or whatever, I mean, they're not making a lot of money on this. They are doing a little bit better because when the Fed raised rates, they hiked their mortgage rates. So, but they're still historically low, I assure you. They're starting to act a little bit better. I've been selling some puts in some of these. I actually outright bought Credit Suisse and Deutsche Bank based on this commodity thesis of mine that the derivative books and the fear of their derivative books is what took them down, and if that risk is alleviated, they need to go higher. So I actually snapped up some of those. Those are doing a little bit better. I have some puts short. Do I have shares? Let me take a look. This is sort of embarrassing. I should know what I own, right? If any of you ever did this, I would probably be giving you a hard time about it. Well, actually, I'm going to have to buy them back. They're almost zeroed. Or I'm going to have to re-up. I'm going to have to sell more put. Roll them, buy these back and sell more. I'm short some puts in Morgan Stanley. Those wound up being a big winner. The stock is starting to make higher lows and higher highs. It's amazing to me that companies like this, I mean, the premier banking, investment banking franchises are trading at 9 multiples. I guess you could say that their earnings are not good, but for me, it just seems to me hard to believe that their earnings are going to get that much worse than, at the bottom. I mean, yields probably at some point have I guess they have a zero, they can't go to zero, although you'd never know that in Asia and Europe with the ZIRP. We have ZIRP here. They have NIRP, which means negative interest rate policy. That is also heavily weighing on those banks. The Credit Suisse and the Deutsche Bank, they not only have a commodity, perceived, whether or not they are or not, perceived to be on the wrong side of a commodity trade, but they don't even have positive interest rates. They have negative interest rates over there. Really, really bad for their loaning. I mean, think loan books. They tend to borrow at the short end and lend at the long end, but it's bringing it all down. Some of these companies are trading below book value, like Bank of America. These companies, they're all trading pretty low. BAC, someone asked about that. It's looking better to all the same pattern. I will caution you this: 1538 is the 61.8. You probably want to. It's also a high volume node. You have a 200 MA at 1557. Start to lighten up. Today looks like it had a bit of a look above and fail. I'd be a little bit cautious with that, but there is a little bit room higher. The key level for it to hold is 1460. Let's see. 1460 to 14. This is where my eye comes into play. Really, 1389. Yeah, 1389 to 1404, but anything below 1460 to me is a little iffy. It also would be a break of the 10-day MA. I'd be looking to take a little bit of profits in bank. I'll tell you, you could BTD down maybe in the 13s, but I would be booking some as it rises. TLT also, while we're on this theme of interest rates. Today, to me, said lower. It looks like lower for longer. You had the double bottom yesterday. Today went higher. I'll tell you this: if you get below yesterday's low on TLT, you got to be a little bit more cautious because you now have a break of a double bottom and a break of an interim swing low, and that to me would start saying that the probability of a rate hike is getting maybe a little bit more possible, at least the fear of that. I don't know how crazy it's going to get. You have the 200 MA down in the 124s. The 123.15 was the 2009 crash peak. That shows you how low and depressed interest rates are here. There's no money demand. There's no demand for money. It's incredible. And we also know banks, the loan structures are tough. It's tough to get loans these days. It's not like the good old days of the ninja loans, right? Where I guess janitors could buy $1 million mansions. Doesn't work like that anymore. Let's see, what else do I want to talk about? All right, so a couple of issues. First of all, I want to define shake and bake for people. Shake and bake is when a stock... I got to... holy cow, I didn't plug in my iPhone here and the battery's dying. Let's plug that sucker in. Sorry, one moment. There we go. Shake and bake is basically when a stock is run up, you get a sharp pullback right before earnings, and it sets up for a long. The key there is not just a little pullback. It's got to be dramatic. It's got to be panicky. You have to have a little bit of blood in the street. So that's the difference between a pullback and the shake and bake. Exxon, I want to talk about Exxon. So something happened yesterday that's a little bit of yesterday they were downgraded. Their debt was downgraded by Standard & Poor's. I really don't understand why. They cited the commodity going a little bit lower. If anyone hasn't looked, oil isn't trading in the 20s or 28 anymore. Oil bottomed at 26.05 and is now breaking out to new highs into 45. So if they were going to downgrade Exxon, where were they $20 ago? Seems a little bit late to the party to me. Exxon, in a move of hubris, came out today, the next day, and raised their dividend. Okay, so here's the problem. Exxon reports on Friday. Anytime, and this is discipline, I've seen this so many times. Maybe Exxon is the exception because they had the downgrade, and this was sort of just like a flipping off to S&P. You want to downgrade us, we're going to raise our dividend. That could be the case. In my past experience, when companies raise a dividend right before they report, that means they're going to have a crappy quarter. BP had a good quarter, it went up, and Exxon is so much better than BP. It's not as levered as BP, so BP, of course, as oil is rising, is going to get a bit of a extra, bump. But, and I've been real bullish on Exxon. Today I closed some of my puts, my short puts. I would love to, and listen, it just broke out today. It's getting through a bit of a channel high, 88s, it's beautiful. Listen, I was talking about this stock being one of my favorite stocks a few months ago when this thing was kissing the canvas in the 60s and 70s. So they report with Chevron. Listen, there's room up into the 90s. I will tell you this, you're starting to get into some areas of reference resistance around 90. If this rallies ahead of the number as it has been, I would just say, book a little bit of the profits here. I do think that it's going to get eventually to 100 again. I know that would be a shame to miss, but discipline here for me trumps conviction, and it has rallied nicely into the earnings. I am looking to book some profits. I don't know that the stock won't go higher here. I just know that I don't like when companies come out a couple of days before they report and raise their dividends. I forgot what stock that was a few months ago that did this, and I warned you guys about that one also, and then the stock got killed on earnings. So I can't remember the one. If anyone wants some brownie points with me, if you remember what that was, just let me know. But I remember something came out, I said it was sketchy, and they got murdered on their earnings. I don't think Exxon's going to get murdered, but they could pull back to 83. That would be a little bit painful if you were first chasing it here. Anything else I wanted to talk? Oh, so today, of course, they'll probably wind up screwing as many people as possible. We had both poor highs and poor lows in the market profile today. That means that the high and the low both could use some repair. Yes, the BOJ. For me, the Fed trumps the BOJ, though. So that could cause some issues with the yen. We all know that they've been... I can't see them being hawkish. They need to get the yen down. So I would think that they are going to be trying to move heaven and earth to come off as dovish as possible. Let's see. I wanted to cover some more of the stuff you guys were mentioning. I'm just going to go in order here. Someone asked about Alkermes. That was one that I've been long. I did, truth be told, I screwed up a little bit with this one today. I didn't realize that they report. I know they report earnings tomorrow. I didn't realize they report before the bell. I wound up taking a little bit of profits today. I was How I screwed up was this, is that if I knew that, I would have put a stop below yesterday's low and used that. It wound up getting a little bit below there. We tested below the 1428. We did close above 1428, which was the breakout. The risk I see is a bit of a pullback here. Listen, I think that this could fill the gap. I think it will eventually fill the gap, but I don't know that it doesn't need a little bit of a pullback first, since this ran from 27 to 43. That's a really, really big move. Of course, it broke down from 60. I'd be looking to buy this on a pullback somewhere between, I would say near the 50 MA maybe, if we can get a move down, maybe somewhere between 35s and 33s. I don't know that that happens, but I didn't want to let a stock that I had an over $10 gain in. I bought this thing really, really well. I had over a $12 gain at one point. So I booked it. I was between like a $10 and $11 gain today. I just took a little bit off. I still have a little bit on. It's shaking big me. Yeah, it got me. It shook me out a little. It has poor. No, I didn't sell it all though. I still have some. So I'm looking actually to add on a pullback. So we'll see how that goes. If it does have a pullback, if not, you can buy it again on momentum. I'll tell you this: if it gaps over 43.49, this could be a professional gap and go, and you probably can buy it. For a momentum trade higher, you had 1, 2, 3, 4, 5, now 6 days, like in consolidation, with a pullback today. Sorry, I'm trying like not to explode here. My allergies have been terrible. Yeah, I booked some alchemies today also. Yeah, I think a lot of people did. My only bad today was that it didn't. I didn't realize that it was reporting the pre-market. I thought it was going to be after hours tomorrow, and I was just planning on playing around with it tomorrow. But yeah, I did book a little bit today. The expected move in alchemies, it's big. It's like $4. Oh, that can't be right. Of course, that has. This is really annoying. They only have monthly options, so on the snap tomorrow, believe it or not, the market maker move isn't that terrible. It's only $1.56. So, if they don't, like I said, if it gets back over 43.49, I might just bring it back to a full position again tomorrow. That's my story, and I'm sticking to it. I still like alchemies. I would love a pullback, believe it or not, to buy some more. I talked about oil. I think it's going to 49 to 52 possibly. It is into a little resistance up here around 45s. Silver. I have a little bit of silver via the SLV. I bought it like in the 14s. I held it. I sat through a little bit of pain. I had got stopped out. I bought it back. Anyway, I own it at $14. It looks good to me. It looks like it's consolidating. It's, you might want to wait a little bit if you haven't owned it before. I would wait for a little bit more consolidation, maybe a little bit of a pullback. Listen, as long as it's holding over that real breakout in the 15, I mean, it's a lot, I mean, I hate to say this because I like silver. I like buying it on pullbacks. Silver has been underperforming gold. Actually, it looks like it's maybe outperforming lately. But yeah, I mean, I like silver. I like buying the dips in silver. If you get any jackedness in the puts, you could sell the puts. But yeah, I like buying the dips in silver. Facebook we covered. Bank of America we covered. This FireEye, someone asked about FireEye. I have a little bit of FireEye. It rallied. It's consolidating. I can't, I'll tell you, the Fed had their special question the other day in the Philly Fed. And the biggest things that the companies have been spending on are security, cybersecurity, regular security, and compliance. I have to think at some point this was a bit of a fad. It got a little out of control. It probably overshot here on the downside. We're going to have to see how they report. That CEO is a little sketchy sometimes. But I have a little bit long, if that means anything to anyone. It's not a big position. It's not going to make me, it's not going to buy me a Tesla, and it's not going to have me, singing for my supper at Port Authority either. It's, a little bit here, a little bit here. I nibbled. Based on that, maybe they do get a bit of a bump. I would think that at some point that these stocks probably get bought. That's just my thought. Twitter. oh, this company, this management, I don't, what are they doing, right? I mean, what are these guys doing over there? I mean, you think these guys were selling Fabergé Easter eggs. They have a hot platform that would be valuable to somebody. They just don't know what they're doing over there. I mean, it's like, I will say this, though, in their defense. The company isn't super duper expensive here when you factor in their cash. They have a lot of cash on balance sheets, so the chances of this thing being a zero are very low. It doesn't mean that this can't be a single-digit wonder for a few days or a few weeks, but it seems to me that the stock is getting close to where it maybe is fairly valued, famous last words, of course, and none of their initiatives, they stabilized their MAUs, which is the monthly average users. Facebook grew theirs at 15%, just so you can see the difference. When everyone's like, oh, Twitter's cheap, Facebook grew their average monthly users at 15%. That is ginormous. Yeah. Anyway, the story with Twitter is that they none of their initiatives, like the NFL and a lot of the stuff they're doing, have been factored into their earnings yet. So I would imagine there's a little bit of room. It should get a little bit better. I have a smidge of Twitter long. Again, the same kind of situation as FireEye, not a big amount. I just don't think that this is one day you might wake up to this having a bid. Who knows? It's just take it off your screen, black tape it. It's really nothing. There's nothing to see there. If you want to be involved in the space, Facebook. That's it. Sorry, it's going higher. Etsy. All right, so I've hated this stock. Absolutely hated it. I remember my friend was talking about this. She was all excited when it came as an IPO, and I told her this thing was going to single digits, and it did. I guess I'm sometimes a bit of a come off as a bit of a a schmuck or a prick or whatever, but I was right. Listen, I hope I saved her money. I think she got stopped out, so it worked out. But I'm starting to change my tune on this. It's starting to look like an inverse head and shoulders and a rounded bottom. We all love those. Didn't Kim Kardashian break the internet with her rounded bottom? Maybe Etsy will do the same for us. It's pressing right up against the neckline for the breakout of 940. I forget where I bought this. I think I bought it at $9, maybe a little bit lower. I have to check my fills. Yesterday it had a bit of a BS move, and I had mentioned this in the weekend video that it could see the 50 MA. I didn't think it would do it so fast. It did. We're above that high. It looks good. I think the stock looks like it's going higher. There's a channel high. If it goes all the way up to the channel high, you're talking about mid-10s. That was also, oddly enough, a breakdown point. For some reason, I have my sell order in here at about 13.10. All right, whatever. I'll monitor it. So that's what I'm thinking with regard to Etsy. Twitter, Etsy, Micron, someone asked about. Not one I really follow that often, and it's looking a little bit better. Also looking like a bit of a rounded bottom. And below 1195 for some reason I have, why do I have that there? I think that was an old breakout, so I guess it's a little bit vulnerable. I mean, I don't really know that much about this company. I know semis in general. Listen, I'll tell you this, if you're not in drones and mobile and all that, you don't, I just don't see how these companies are doing well. This has been the problem for Intel also. They missed, the drones, they missed the mobile. They're really not doing, it's just like an old line business that's sort of a legacy business. That, computers are not doing that well, and they've missed the big areas of growth. The one that has had that is this Ambarella. I've been playing this via short puts. I've had a bunch that have expired worthless already, and I have some more on. It's roughly around the channel low here. I drew in a new potential up channel here, so it's kind of, if you're going to buy it, let's see, you have well, I didn't quite get it. There's a little bit lower. It could go to 40 half-ish, 40.54. But they do have earnings coming up. The pattern to me looks like okay. It's been making some higher. This last round of highs was lower than the last. So you're making higher highs now, higher lows, but like kind of equal highs. I still think the pattern looks okay. If you want, just draw the trend line in there. Or if you want, you have 2 days of trade here, both below the 50 MA. Just on a 50 MA snap, you could buy it higher. You'd be over the 2-day high, both of which were doji, hammer. Yeah, I mean, I would just wait till it gets over the 2-day high. That's Micron. We covered Apple. Covered Alchemies, covered Ambarella, covered Amazon. Wow, I really did a lot. Facebook we covered. Oh, someone asked about IBB. That's a gauge of risk that was not doing particularly well today. The key for IBB is to hold between 275.40 and 271.77. There's a little bit of give, I guess, to the 50 MA there, but if it breaks that range, you might want to be a little GTFO or row short. But as long as it holds there, it's kind of still okay. That's the IBB. What else is on here? Under Armour. Oh, so someone asked me the other day which one I like better, Under Armour or Nike. I said short-term Under Armour versus the 200 MA. You lost the 200 MA today. I would be, you got the gap fill, so I guess you got to use today's range. The gap. I mean, honestly, I don't really love any of these stocks. I think I was clear about that. This is the wrong time of year for apparel. That's more of a end of summer into the holiday season. Nike, though, I am more of a longer term bull, but listen, this thing ran up huge. It's got room to pull back, and I would be a buyer lower, maybe on trend. With regard to Under Armour, back to that. Listen, you had a bit of a failed breakout. I wouldn't say it totally broke down, but if you should have been stopped out at the 200 MA. So anything below there is a little bit iffy. I think you could use today's range. If you could get back over today's high, it's probably a long. That's Under Armour. The dollar. Let's end on the dollar. That is a really, really key to this whole mishigas. How did we close? Interesting. So I've drawn in a range for the UUP, and I've bracketed off with resistance and support. The support the support low I put is 24.47. Anyone want to guess where the UUP closed today? To the tick, exactly 24.47. We have a Fed day today. We know what that means. That means the Fed day range is what we either play long above, flat in between, or short below. Very simple. I'm going to say the same thing about the dollar. I'll tell you this. If you can get the dollar to really break down and take out the last swing low of the 24.29, the market, as in the stock market, will sail off into the wild blue yonder with new highs, is my guess. We are at the lower end of the range here. We know that moves below there have been unsustainable. I would be a little cautious. That is the one fly in the ointment if you start getting a major rally in the dollar. We'll have to see what these European characters do, because that's mostly when people talk about the dollar, they most completely compare it against the euro. But I will say this, just be a little cautious with the dollar. If that really starts taking off, it could be a big, or if oil starts breaking down, both of those things will not go over well in S&P land. Very, very simple. So that being said as well, and I guess we'll end on that, is the VIX. You didn't get a lower low in the VIX today. You did hold the 10-day moving average there. You have a little excess from a few days ago. There's room, believe it or not, for a little bit. Yeah, someone was just talking about the UUP. Yeah, I think it's just the point in the range where it was. The Fed was not hawkish today. I'm sure if we're down tomorrow, everyone will say they were, but they really weren't. This was a punt today. This was really a punt today. This was not a hawkish Fed. It wasn't like overly dovish, but if I had to put, a weighting on it, I would say they were way more dovish than they were hawkish. And I just cannot see them getting jiggy in front of the Brexit. There's too much risk there. That could be a disaster. So I think it's just a range issue there. Anyway, keep an eye on the VIX. There is room for a little bit for it to rally. I could even see a scenario where the market's rallying and the VIX is rallying, and then everyone gets like, their panties in a bunch, nervous. Why is the VIX rallying? What's going on? What does someone know? It just where it is in the range. Most people assume that the VIX has to go higher on put buying. That's usually the case, almost always the case. But I will tell you, it's possible if you do get into like some kind of crazy blow off top here, that call buying could also set the VIX off, and you could see a rising VIX with the blow off top. That will also let you know that we are in a blow off top and be looking for the short that could last for years. I don't know where that will be, but I can tell you this, that it does seem like like that could happen. I think if oil keeps rallying, and I think if the volatility subsides and you start getting some, the breadth has been expanding, if you get a little bit of love back into some of these Momo stocks, it's very possible that we see new all-time highs. That being said, S&P 210 to 211 has been a very hard area to get through. You can't say higher until those really clear. Once those clear, I think we see the old all-time high and probably print a new all-time high. Anyway, that being said, that's my story. I'm sticking to it. If you're caught this late, came in, want to watch it again, or it's going to be on my YouTube channel in a couple of minutes. I'll probably post it now. You can rewatch other videos, see my weekend review, which was pretty good this week. It's always good. On my YouTube channel, it's Justin Pulitzer Trades. If you're not following me on YouTube, be sure to do that. Subscribe, and be sure to follow me on Twitter. It's @JustinPulitzer. Anyway, I hope this was helpful. Please leave me some feedback. It always helps me make better videos. So let's have a good rest of our week, and cheers.